Good morning, everyone, and welcome to the Ankerstar Wealth Morning Show. I'm Steve Ankerstar, your host, and today we're going to talk about two different questions out there: are we going to test the market lows, and are the Fed rate hikes going to work? Is the issue, because we've been going in with the assumption up to this point that the Fed rate hikes are going to take care of inflation. So far, we haven't seen a whole lot of movement in the inflation. Moving down, that is. So is it going to work? And I want to talk to that a little bit with you this morning based off of what I heard Thursday night. Before we begin, as a reminder, so financial education presentations should not be construed as personal financial advice. Full disclaimer information is available at ankerstarwealth.com. So let's start with the first one. Are we going to test new market lows? Well, it certainly looks like we are. Let's switch over to CNBC. Here's what we have. We're just past the market open this morning. I'm running a little bit late. Hey, there's some green, right? But I wouldn't get too excited about this green, is all I would say about that. We'll pull up the S&P 500 to look at the actual chart. And I get this question all the time. It's like, how do you use technical indicators? You've heard me say it before, but as a reminder, this is a 1-year chart on the S&P. I look at them like everybody else. You can't ignore them. I'm more of a fundamental kind of guy as far as investing, but I think the technicals are certainly they're what I called self-licking ice cream cones, or self-fulfilling prophecies, is because if enough people are looking at technical indicators, then they become real. Because people are allocating capital based off of where a chart is, which if they're doing that, they're obviously moving the chart. So they can actually, if you allocate enough capital, you can make yourself right. What do I mean by that? If you take any small traded stock out there that has less than 10,000 shares a day, go buy a bunch of it. You can see that you personally can move the market higher in that stock, not the overall market, unless you're swinging a pretty big bat. But things can, get artificially, move because of certain ranges. So why I bring that up is here's where we are, and I will own this. We had this nice pop this 6 weeks during the mid-June to mid-August. What was the narrative at the time? We had 2 75 basis point rate hikes. The narrative was that we are past peak inflation, and the narrative was we were past the point of peak rate hike. I know that can be a little confusing, meaning not rate hikes are over, but we would stop the 75 basis point rate hikes and move on to 50 and kind of wean ourselves off of that. The markets celebrate certainty, right? So we have that in mid-June to mid-August, and that is over, what everybody expected. But then the inflation numbers came in, and we did not get that, significant move down across the board in inflation. Inflation's measured in several different, indices, that sort of thing. But, commodities have come in, some other things have not. So overall, is inflation breaking? Well, really, no. And if it is, it's not breaking it in enough, large enough to actually be able to say, okay, for sure it's working, right? So that changed the narrative a little bit. It changed it enough to where, Chairman Powell said at his Jackson Hole speech not too long ago, said expect more pain ahead, right? Meaning that was forecasting that we're probably going to have a 75 basis point rate hike again, a third one now, if you're tracking these things. So that's how the narrative started changing. And we just had that 75 basis point rate hike last week. Obviously, the market sold off hard after that. And now, you can see the slope down in the S&P here, pretty steep, right? I mean, that is a steep sell-off right here. It matches what we saw in January. It matches what we saw kind of in April, and then certainly at the beginning of June. But after we had that steep sell-off, the market turned around and went higher. So for the past 10 years, actually 13 years, if you go back, if you've been an investor only since 2007, 2009, right? So you're not necessarily new to the game, right? Because that's over a decade. But if you haven't been a lifelong investor, you've been kind of conditioned that, two things, right? The market always goes up, because it does. And then because that's been your experience, right? And then secondly, is that sell-offs are times to buy the dip, right? So market goes down and you put, if you have more cash, I get it, everybody doesn't, but, if you have more cash, or you're working and you have a 401k that you're jamming money into, market goes down, you buy more shares when they're cheaper. That's dollar cost averaging. You buy the dip because that's how people get rich. And I agree with you 100% across the board. However, the narrative that was changed for me personally Thursday night was I sat down with there was a private event with some Blackstone folks from New York City, and they're private equity. So they are, very smart on the economy and everything, but also their main investing thing is private equity, which is a little different than what we do. And I know I have some of you in not only Blackstone stock, but also their private placement holdings. That's not right for everybody. You do have to be accredited investor, so there's minimums and all that. And they're not liquid, right? You tie up money for a good, year plus sort of thing. But their take, and I've always really respected their take on things. And they made a killing through 2007, 2009 through distressed real estate. But they also have expertise out of that. And the overall take that the person they sent down from New York City to talk to all of us here in Texas, which was mostly institutional money. It was mostly, Texas Endowment for the University, TRS Fund, Teachers Fund here in Texas. So, big numbers. I was the small number guy in the room, clearly. But still their take was the same of, what if the Fed rate hikes don't work? It's like, okay, let's peel that back. And he talked for about half an hour and said, okay, in the past, you have inflation, you raise rates, and that cures the inflation. And then after you raise rates, you now drop them back to a stable level and everybody's good. So consider like going to a doctor, right? So you have a problem and you go to the doctor for what's the cure, and the doctor's like, okay, here's your cure, and it cures the problem, and then everybody moves on with their life. That is like the perfect world. The imperfect world is, or say, let's take it to an extreme now, of you get cancer. Obviously that could, life-threatening sort of medical condition, not necessarily, but for, a significant medical condition for sure, anytime the cancer word comes out. So, and now say the treatment that's being prescribed to you is now the interest rate hikes, or the chemo, if you will. So a chemo treatment obviously is going to cause some damage, because that's kind of how it works. But you accept the damage because it cures the disease. So when you relate that to, we have inflation, and then you have the cure being the rate hike, which obviously has some collateral damage of throwing the economy into a recession. But you accept that, if you will, from a policy / decision-making, what's the best for the country, you accept that, right? You accept that because it's going to cure the inflation. And you say, okay, when inflation goes away, we'll kind of back off on the rate hikes. We'll get back to normal and everybody goes about their business. Okay, that's great. Now, here's the problem with that. The problem is we don't have enough data points over history to really know. It's like millions of people have cancer, so of like each type, right? So doctors kind of know a ballpark of what to use in certain situations. Well, economists, we don't have the, million cases across the board to look at. We have a few points in history, and, most recently the 80s, if you will, is when we had some decent inflation. And did the Fed rate hikes at the time, did those work? There were rate hikes and inflation did go away, but does that mean it went away because of the rate hikes, or did it really go away from something else? So there's a lot of unknowns here, more than, a lot of people that say, well, this happened last time. It's like, well, okay, yeah, but that's one data point, right? So why do I bring all this up? Well, it kind of depends on where you are on the investing spectrum. If you are young and working and you're okay with risk and you don't mind seeing your portfolio going down on a daily basis, and then I still have the S&P chart up here, so it's pretty much been a straight move down from mid-August. You were over a month of this straight move down, right? And that can wear on a lot of people. So if you're on I love it. I can't wait for stocks to get cheaper because I'm going to buy more. I'm killing it in my job. I'm jamming money into the market. This is great. We'll keep doing what you're doing. Yep. Fully support that. I've been mostly a buy and hold person my whole life. Of, market sells off. I'm like, good. Well, I'm going to pick up, my favorite. I talk about all the time, Apple shares on the cheap, period. Dot. You're like, no problem. Right. And, you know, when you see charts like this, there's a lot of up and downs. You're never perfectly right. You're never perfectly wrong. You have to be able to operate in an uncertain environment. And investors are fine with that because they see all their assets moving up and down on a daily basis. It's all part of it, right? So that's one thing. If you are in the, hey, the other extreme of I'm either already retired or doing my retirement calculations, you may not either have the, you know, there's risk tolerance and risk capacity. And I don't talk about those two a whole lot, but you need both, right? You can be like the world's most aggressive investor. That's your risk tolerance. Like, yeah, I don't care. The stuff can flop all over the place, but your risk capacity is actually more grounded in reality. Like, oh, well, you actually can't afford to lose, you know, another 20% of your net worth here as you go into retirement phase, right? So you may want to, but in math doesn't support your decision making there, right? So that's more the risk capacity sort of thing. Well, we're right at the, you know, the point of new lows, and I talked earlier about technical factors, and this is why I bring this up. So you have an overwhelming theme of, you know, the rate hikes may work, but we've been listening to the Fed chair and, you know, and following it in the markets, and it hasn't kind of worked yet, or it hasn't, if it's worked, it hasn't worked to the amount that we had hoped, to kind of give the, okay, everything's on track. So you have that narrative. And then plus technically we're right at the bottom. We are right at the bottom of, you know, 2022, which is also the last time we were down here was back in 2020. And from a technical perspective, when you retrace a previous low, there's a free fall zone there. I will tell you that happens in individual stocks. It happens in overall markets. When you retest a low and it doesn't hold, there are no buyers for that next, like, you know, 4, 5, 10% move down, because now you're in unknown territory. If it holds, so if we hold in this category and start marching back higher, I'd feel a lot more confident. But if we blow through this and continue the selling, which is honestly what I expect to happen, is now we could be looking at a significant move down. So if you're in the don't care, I can buy and hold my way through this, that's fine. Do so. Just realize that, you know, that it's probably not going to look like 2020, where yeah, we had a video out every day. I said, you know, hold the line. You know, gave the lock and load video on March 24th of 2020. It was probably my defining moment as far as investing, as far as an individual daily call. It was one day early before the bottom. I don't see the recovery snapping back like that, right? I don't see all of this going away. You know, in Fed terms, if you want to geek out for a minute, you're talking soft landings and hard landings. I don't think there's a soft landing opportunity, especially if you go to new lows today. That'll be a hard landing. And then country, you know, goes into, you know, technically you could say we're in a recession because we've had the two, you know, consecutive quarters of GDP, negative GDP growth. The government hasn't acknowledged it yet because we're almost at full employment. But certainly if we continue rate hikes at the pace that we're at into 2023, the year we're going to end up in a recession, and maybe we're already going to be thrown into one anyway from what we've done already. So anyhow, this is to temper your expectations. So what do we do in this case? So we've talked significantly over the year about bear market strategy. Get rid of the speculative stuff, plan on holding the best of breed and the thematic ETFs, that sort of thing. However, if you're at the point whether you either personally don't want to, or you're at a point in your, you know, particular time in your life where more losses could cause undue problems or stress, it's, you know, I did the last video I did on Thursday was on how to reduce risk. You can actually build some cash here, and I have done that in some accounts. You know, started to acquire some cash. And when you say, okay, what is your plan if you are building a cash position? Well, the number one plan of a cash position is an expectation of the market going lower and you being able to buy back in at a lower level. So that's the reason you have cash on hand. So when you start building cash positions, there is an expectation that things could get worse. I'm not saying it will. I'm saying it could, and if it happens, we'll be prepared for it. So if that's something that interests you, and I haven't really said that for basically over a decade, certainly since I've been in business, but if you relate to the situation we're in now to what we saw in 2007, 2009 or the 2000 tech bubble. People sometimes can forget how far the market can actually sell off. Right. Go back and look at some of those charts and you can see that, yeah, we're down 20%. It does seem like the end of the world, but 20% moves down are not actually, they're not they're not honestly a really big deal, but you get into 40-50% moves down. I'm not trying to say I'm not making that call, but I'm saying it can happen. Right. So we need to really be pretty on top of things as far as what we're doing and very intentional in what we're doing. So if you see cash showing up in your account, that's why that's there. That's not for because we're out of ideas. That's because we're concerned and cautious as to how things play out while we're right here at this testing the new lows for the year. So a lot to unpack there today. I went longer than I meant to. Hopefully you listened to all of that. Certainly this is the defining video that I'm going to send out to folks if they see cash showing up in their account. They're saying, hey, I'm spooked by what I'm seeing here. What's the plan? I'll go back overall to the CNBC for the day and see if we're still in the green. So you got NASDAQ up over 1%. Well, there's lots of times it's up over 1% and then it doesn't hold, right? So I think we're going to need to wait and see. There will be a lot of drama going into the next rate hike, which again is 5.5 weeks out now. But it's more of a stay tuned sort of thing than a crystal clear way forward. I think there could be lots of things that happen here. So thank you everyone for your questions. This video is honestly a compilation of about 20 different questions I got last week. So thank you for those. Please continue to submit your questions as a comment through social media or directly to our email at vipservices@ankerstarwealth.com. That's all we have for today's show. I'm Steve Ankerstar, and we'll see you back here tomorrow. Bye.